Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenivek on Bloomberg Radio.
As we've said, Tim, there's just so much coming at us on this Tuesday, and a lot of it is because of NVIDIA. But there's just so much going on when it comes to AI-related news today.
Yeah, OpenAI continues to forge relationships, as does PayPal. The two announced a tie-up whereby PayPal's digital wallet will be embedded into ChatGPT. It'll send PayPal shares up the most in more than 6 months, or it did send PayPal shares up the most in more than 6 months. And then the Microsoft news that we've talked about quite a bit, Carol. Longtime backer Microsoft, a 27% ownership stake in OpenAI. This part of a restructuring plan that took nearly a year to negotiate. It removes a major uncertainty for both companies and clears the path for ChatGPT and the maker of ChatGPT to become a for-profit business.
It's a lot. So let's get into it and really just how OpenAI continues to be at the center of so much. But we have so many questions about why Microsoft is doing this at this time. Bloomberg Intelligence senior technology analyst Anurag Rana joining us from the Bloomberg News Bureau in Chicago. Anurag, why is Microsoft doing this? Did the company need to do this, kind of cement that relationship financially and otherwise with OpenAI?
Yeah, I mean, they had to do it because OpenAI has been, raising capital with the idea that they will go from a not-for-profit to a for-profit company, eventually going public someday. So, I mean, this had to be done. The big contentious were there are so many things that they were arguing against, revenue share, technology share, all sorts of different things. Microsoft had control over which cloud providers that they can use, etc. So this new agreement kind of cements a lot of those things, removes a big overhang that's on, I would say, more on Microsoft than on OpenAI, frankly, because Microsoft is using OpenAI's technology in their products, in the Copilot products that are out there. That's, I think, for us, that's the most important thing. Frankly, it's not so much the other financial details.
Since Microsoft will have this 27% ownership stake in OpenAI, can we look at Microsoft's share price on a daily basis as some sort of public proxy for OpenAI and how investors are valuing OpenAI? Or am I trying to do too much math here?
No, I think that's a bit too extrapolation over there. The thing that you want to focus on is, for how many years will Microsoft have access to OpenAI's leading models? So when you look at frontier models, you have OpenAI, perhaps, most in the lead, then you have Anthropic and Gemini. Those are the three big ones that everybody talks about. Down the road, Microsoft needs to make sure that the Copilot products that they are selling out to the public, both on the M365 and then the GitHub Copilot, which is used for coding, they really have an alternative to OpenAI. One answer could be they have their own models, but they're not there yet. So this contract, extend that to 2032, which is, you can say that they're giving themselves 7 years to figure this thing out.
Help me out, though. It's just like OpenAI and Microsoft. I'm looking at the Bloomberg, OpenAI and PayPal, OpenAI and SoftBank, OpenAI, pick your company. They are just, I feel like, lining up deals or agreements or relationships with everybody and anybody. I mean, Microsoft, are they going to have to share the wealth, if you will? And does it become a little bit messy? Because I'm just assuming that there will be companies that maybe in some ways are also competing with Microsoft that have deals with OpenAI. Or is that not right? I don't know.
See, it's a very common thing in technology. Almost everybody who's competing with each other are also working closely with each other. So that's, that's on the side. But when you look at OpenAI, that's an area where you and I use ChatGPT a lot. But imagine that now what you can do is, let's say they have a partnership with Walmart. With PayPal today, you are looking at a product and you decide that you can just buy the product seamlessly from that. They have a similar agreement with Stripe and Shopify. So what OpenAI is basically saying, let us be the front end for a lot of what you're doing, let's say on the consumer side. So example that I gave you is more for a retail purchase. But on the other hand, they also have a deal with Salesforce. So for example, if you are in ChatGPT, ChatGPT and you want to look at your Salesforce application, you can do that as well. So OpenAI wants to make sure that they are the front end for a lot of discussions that are going to happen. And that's where I think a lot of the fighting is going to be down the road.
Anurag, we had this conversation with Jan van Eck of Van Eck yesterday, and he talked a lot about AI and the AI trade, but he also mentioned some stats about when web traffic is going from ChatGPT to websites. And it got me thinking about how people are increasingly replacing or supplementing what they do on the internet using ChatGPT. The news today, too, that this potential PayPal tie-up where you can pay for stuff within ChatGPT also got me thinking, does Alphabet have to be scared about its core business here?
But that's been the case for so many years. I mean, people have been talking about this. The first day ChatGPT was launched, that what's going to kill Google's search business? I mean, so far I haven't seen those numbers that are out there that it's having a very large financial impact. I'm sure there is some share loss in searches, but I haven't seen it. So we'll see, how this shapes up. Google has, or Alphabet has, a lot of interesting assets. I mean, they have semiconductors that are very important. They have a cloud platform. They have a large frontier model. So I think they have all the pieces out there. The question is, whether the market is big enough for a lot of them to exist or coexist at the same time.
Hey, Anurag, over the summer, Bloomberg put out how OpenAI said Elon Musk identified Mark Zuckerberg as one of the people with whom he had communicated about potentially financing a deal to purchase OpenAI. Does this Microsoft deal put an end to any other big player coming in? I mean, this is theirs.
I think so, but again, legal ramifications are such that you don't know how some of the judges will move towards. But this is basically OpenAI saying we have figured out a way to how to go, you could say become become for profit, and eventually someday go public.
Yeah, that's going to be interesting, right? I mean, listen.
At what valuation?
Well, and for OpenAI, but for OpenAI, right? They can kind of stop the money grab for now, right? Because they just got a massive cash infusion.
Yeah, but they are also spending at the amount that nobody has seen. I mean, they have a very large contract with OpenAI, with Oracle, and they, today with this agreement, they've committed another $250 billion of computing capacity with Microsoft. So it's, their expense is far exceeding the revenue right now. They are doing these, you could say investments so that down the road they can recognize the value of some of these investments. So that's, I think, where the mismatch is for a lot of people. And so unless there is some equilibrium, I think it's going to be very tough for them to go public.
Yeah, the money flows around AI in, out is like phenomenal. Anurag, you too, phenomenal. Thank you so much. He is Bloomberg Intelligence Senior Technology Analyst out there in our Bloomberg News Chicago Bureau.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It's a Fed Tuesday, Carol.
It is a Fed Tuesday.
Which means it's followed by a Fed Wednesday.
That's how it works. 2-day meetings.
Let's get into it with Danielle DiMartino Booth. She's CEO and Chief Strategist at the research and analytics firm QI Research. She's also a former advisor at the Dallas Fed. She's here in our Bloomberg Interactive Broker studio. We've spoken to you a couple times in recent months. I want to go back to our conversation with you back in July. I remember it because you were kind of the first person to warn me of weakness in the labor market. You talked about the gig workers out there and the people who were driving for Uber, for example, or Lyft, or doing other gig work, and the way that a lot of them, in your view, were overqualified because they couldn't find work in what they were trained for, what they went to college for. Is the labor market worse now than it was back in July?
Judging by my Lyft and Uber drivers, I would have to say yes. The demographics has expanded. And you've especially got a lot of kind of college graduates right now who are looking for gig work because they can't secure work in the broader economy as they thought they would be able to. They walk across the stage proud with their diploma and boom, there's no work. So, I mean, right now, the unemployment rate among college graduates is the highest it's been since 1988. 1988, it was a supply issue because that was the peak of baby boomers entering the workforce. Now it's the flip side of it. It's a demand issue. And these kids are rightfully, they're very anxious.
So when you've got Amazon letting go 14,000 jobs, a lot of it corporate, right? We've got UPS, and that's part of its cost cutting.
Matt Lazzetti at Deutsche Bank says, pay no attention to these headline figures because they're small in comparison to the churn that we see each and every month.
And that 5 million jobs are still being created. So what is the net?
You look skeptical.
Yeah.
Well, I mean, we collaborate sometimes with Macro Edge, and they're an alternative to Challenger Grain Christmas.
Yeah.
And with the UPS announcement this morning, and of course that was so much higher than what was expected, right? It was 30% of what they had previously announced. So we learned from so many companies after the fact about attrition or layoffs rather than layoffs being announced. In any event, at 131,000 announced layoffs for the month of October thus far, and being in the heat of earnings season when so many companies are like, I'm going to get the stock to pop, I'm going to lay some people off. We're seeing the third highest level of announced layoffs in 2 years. So that to me at least is alarming when you do what Chair Powell suggests you do. If you add the lack of hiring to the firing, because a few years ago, there wasn't all of this lack of hiring. Now it's very much a pervasive phenomenon in addition to the layoffs coming through.
Yeah, and then there was the hoarding that was still going on after the pandemic. People were freaked out. They couldn't find workers, right?
Absolutely.
Pandemic, post-pandemic. And so they're like, let me hold on to it. I mean, UPS is up 8%, and they're,
UPS is flying. But look at the 1 year chart.
Yeah, that's a good point.
Of UPS. And that required 48,000 layoffs in addition to the 34,000 they announced. There was another 14,000 in their corporate office. Amazon today said that's 14, but that's 14 of 30. And we know that
stock's down 30% in the past year. Well, UPS.
Yeah, UPS. Oh, yes, absolutely. So,
so then
got quite the yield.
All right, one word. How do you describe the economy? One word.
Weak.
So does the Fed obviously needs to cut in your view?
I don't think the Fed has any. Yes, the Fed absolutely has to cut. I think that they begin to discuss, given the magnitude of the layoffs that are rolling in and the lack of hiring that Chair Powell said could in and of itself increase the unemployment rate. I think that right now what they're discussing is 25 or 50 in December.
So can I just throw at you, like Tim and I have had lots of conversations about earnings, right? Earnings growth is there. Revenue growth is there. So companies are doing well. Like that's the analysis that has come our way. And it's not just big tech, although we'll see what big tech has right this week because we get a big read. But it's been broader based.
I would say that earnings...
Do you not agree with that?
No. I would say that earnings are doing better than revenues. And so in one survey after another, whether it's a CEO survey, a CFO survey, a regional Fed survey...
But there is revenue growth that's, I think, coming in better. That's, again, what people
There is revenue growth, but remember, these are all based on lowered bars that are easier to get over. I mean, if you want to look at the entire revenue picture, I think it's important to bring in the BCY Go function and look at the bankruptcies that are coming in on top of this. And that is, S&P has been tracking monthly bankruptcies for forever. And last month, September, came in at the highest number in the post-pandemic era of bankruptcies. And we're seeing BCY Go is hopping. Whoever's in charge of that is busy.
So is we talk a lot about the K-shaped economy when it comes to consumers, but is it a K-shaped market where and we know this about the S&P 500 companies that there are the Mag 7 have just carried this index for years.
Sure.
But are you seriously concerned about pretty much all the other companies?
Well, I mean, if you're asking me if I'm seriously concerned about the other 90% of Americans who are outside of the top 10% who represent 50% of spending, yes, I am.
Yeah.
And I think we're seeing that in freight.
But we're seeing it in freight, and we're seeing it in some companies, but we're not seeing it. I mean, we're at a new record for the S&P 500
we're
right
not
now.
seeing it in asset prices.
Why are we not seeing it in
stretch.
asset prices?
Well, there's something very automated about this market, and this market will continue to feed on itself because that is the structure of passive investing. Passive investing forces stock prices up because you have to buy the biggest market cap. Look at NVIDIA today. But that is a function not of necessarily enthusiasm about NVIDIA, the stock on a fundamental level, the way we used to think of portfolio management 101, but it is a function of passive investing flows.
So what do you tell investors? Do you just tell them, get ready? Or whenever to hit the fan kind of thing, or what?
According to Bloomberg, the cost of hedging against a decline in the markets is very expensive right now. So we know that. We know that portfolio managers are very nervous about what's happening. But no, I actually watch the Fed the most closely because you've got, all of this money, trillions and trillions, I think $13 trillion in cash equivalents, money market funds, et cetera. That's predominantly owned by people who are 70 and older. So as long as the Fed does not cut too much, I think we're okay. But if the Fed starts to cut into what retirees consider to be the corpus of their monthly income, because they have really enjoyed the Fed being higher for longer, they've collected every single 50 basis point cut by the Fed, you take $71 billion of cash out of the hands of retirees. We don't want for people who own 40% of the stock market, i.e. the 70-year-olds, to even think about selling, because that unleashes passive.
Okay, got to leave it there. Hey, thanks. Good to see you. Danielle DiMartino Booth, CEO, Chief Strategist at the research and analytics firm QI Research.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
Let's not forget, we have a big storm. We know Hurricane Melissa has made landfall in Jamaica. Strong winds. And so it's something. We're talking about a Category 5 storm. This is a very serious storm.
Yeah. Melissa crossed into Jamaica with sustained winds of 185 miles per hour, making it a rare Category 5 hurricane at landfall. It struck near New Hope on Jamaica's southern coast, is about 25 miles south of Montego Bay. The U.S. National Hurricane Center said in a statement at 1 p.m. at New York time. Since then, its strongest winds have weakened to 160 miles per hour, still at the top of the 5-step scale. We got a great voice with us. I want to bring in Eric Roston. He's Bloomberg News climate reporter. He joins us from New Jersey. Eric, it's too early to be talking about the actual cleanup effort. We don't even know the devastation that this current storm will wrought, and also what happens later on in hurricane season. But you've talked a lot and you've written and reported a lot about the big business of disaster recovery. Let's talk numbers here, because you looked at those numbers of in Asheville, North Carolina, for example. Just how much does it cost to clean up after one of these natural disasters?
Well, just to take readers back a second to a year ago, at the end of September 2024, Hurricane Helene technically was a tropical storm by then, but didn't matter. Instead of going out to the Atlantic, it took a left at the Appalachians and brought us just about the worst Appalachian hurricane you've ever seen. That's not a phrase we're used to hearing before. In December, after there was an accounting, North Carolina came out with a report saying that it caused $60 billion in damage, concentrated in the western part of the state, which includes Asheville.
Wow.
Yeah.
The cleanup effort has largely been completed when it comes to the immediate aftermath of removing debris. There was 3.5 million cubic yards of debris removed from Buncombe County alone. That's the county where the city of Asheville is located. And what you miss from the numbers is, and I spent time down there in May, is just the incredible vitality of this community and the incredible pride of Western North Carolinians. Of course, other states were hit as well, in trying to claw back from the worst hurricane that part of the state had ever seen.
You know, I got to say, Eric, that doesn't surprise me. My husband has a family member who is living in that area. And just, first of all, the neighborhoods coming out to help one another with generators and so on and so forth. But then, you know, everybody kind of had to leave because there was no infrastructure left, really, you know, to be there day by day. But as you say, it's impressive, like the comeback or what people want to do to bring everything back. It's interesting in a day where we're talking a lot about the U.S. economy. We're waiting for a Fed decision. We have a government shutdown. We don't get a lot of government data. We're trying to figure out what is the economy going forward. What will be the strains on the economy? Maybe AI will mean less job creation. Here, unfortunately, these extreme weather disasters, communities do often want to build back, right? And that it comes at a cost, but it also creates economic activity.
It does. There's and economists always, for decades, have been fighting about the relationship between disasters and growth, with different high-ranking folks coming out on either side. What's interesting? So I went to Asheville in May, which was 8 months after the storm. There were shoots of renaissance in business districts coming back. And the story that we ran last week is a profile of this very quiet but very, very large segment of the U.S. economy that is increasingly being called on to rebuild after disasters and to help places prepare for the next one. And another leg of this conversation for the last generation really has been government spending. And whereas until maybe 2016 or 17, the U.S. government was picking up the bill for maybe a third of recovery costs in disaster-stricken areas. That number has been falling dramatically since then. It's probably down under 2%. And so there's a lot of questioning now and a lot of concern about where is the money going to come from if the government is stepping back to pay for the services that we need before, during, and after disasters.
Well, there's also
the disasters are going to keep on coming.
There's also the question, Eric, of how this changes the economic landscape in these areas from a housing perspective. I mean, we've had reports coming from places such as Malibu that insurance costs have become so burdensome that you see homes for sale for a tiny fraction of what they would cost if they were insurable. One of our guests a few months ago just shocked me by noting that you could get like an actual house in Malibu for like just over $1 million, which is a shockingly small number. We're seeing this affect the real estate market in Florida as well. Is the free market solving this a little bit?
Where the free market, like the whole system, if you talk to economists who look at systemic risks, we're a little bit protected from these disasters just by the nature of how they hit. Like they don't, fortunately, or they fortunately haven't yet like hit everywhere at once. And so the places that are undergoing this kind of level of suffering, that, I can only imagine what's happening in Jamaica right now. There's got to be something that hits everywhere at once, right? For the systemic focused economists to really raise alarm bells. And they've started to, exactly because of the dynamic you described, which is we have a system of federally backed mortgages that hinges on potential homeowners being able to get insurance policies at a time when disasters are becoming more intense, more frequent, and more expensive. So the systemic concern, to the extent there is one, and this has been mentioned at very high levels, the head of the Fed earlier this year expressed some concern about it in the decade or so ahead.
Right.
That is something to keep an eye on.
I think what's fascinating too, there's a lot in this story, but you also cite John Stevenson, who's a senior analyst at our Bloomberg Intelligence team, who created an index, the Prepare and Repair Index, and it's about 100 large public companies that will be involved in these extreme weather, situations, cleaning up. It reminds me of one of my first jobs in broadcast business journalism, and it was a mutual fund show. And when there was an earthquake, we would put on fund managers or CEOs of cement companies because it was just a logical investment play. It feels a little cold, but it was kind of the reality of our world. Incredible story. Highly recommend folks check it out on the Bloomberg at Bloomberg.com. Eric, thanks so much. Eric Roston, Bloomberg News climate reporter, joining us out there in New Jersey.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We got to talk about everything. Or at least, I'm not going to make it everything because that would be exhaustive. That would just be impossible. But we got to talk about a lot when it comes to everything happening with nuclear energy. Shares of Canadian uranium producer Cameco rose as much as 27% to a record high today. This after the U.S. government signed a pact with Westinghouse Electric, Cameco, and Brookfield that will see at least $80 billion of new nuclear reactors constructed in the U.S. to accelerate nuclear power and AI deployment. And breaking late yesterday, NextEra Energy planning to restart a nuclear power plant in Iowa, primarily to supply Google data centers. We got Will Wade with us. He's Bloomberg News energy reporter. He joins us here in the Bloomberg Interactive Brokers studio. Did the U.S. make a mistake, Will, in shutting down nuclear reactors over the last few years?
Ooh, that's a tough question. When they made those decisions to shut down reactors, and I mean, I used to keep a spreadsheet on my desk. I call it the dead nukes file of the dozen or so reactors that were shut down in the past, a little more than a decade. It was the right decision then. They were expensive to operate. Nobody wanted to pay that much for power, but the world has really changed around us.
And I think at Indian Point, close to New York City, that one didn't it outlive its like life cycle? It was sort of at the end of its life.
Oh no, it was closed ahead of time.
It was closed ahead of time.
Yeah, that was a big political campaign. There were people that were really worried about having a nuclear power plant so close to the biggest city in America. I mean, that's a legitimate concern, but we closed that plant and immediately people started saying, wait, New York State carbon emissions are going to go up this year because we replaced all the nuclear with natural gas? Like, who would have thought?
So it does feel like we mentioned the U.S. signing an $80 billion pact to boost nuclear power in that AI push, Google buying power from NextEra nuclear power plant being revived. So the spend is on, the deals are on. Is the build on, though, to really build out maybe the nuclear capacity that's needed?
Oh, building nuclear? No, nobody's doing that.
But the money's there. The commitments are there. The mothballing is being undone, right?
Okay, so here's what we're seeing. There is an enormous amount of interest in nuclear energy right now. I've been seeing it for 18, 24 months. This is because electricity demand is going to go through the roof. That's largely for data centers and AI. It's not just that. It's for a lot of things, but that's the big part of it. We need new electricity. We need a lot of it. We did not see this coming. We were not building new nuclear plants. At the same time, we would love our electricity to be clean. So that really makes nuclear the best option because it's available around the clock, unlike wind and solar.
Right.
How quickly can nuclear power plants be built outside of the United States and China, Korea, Japan?
Oh, China's really good at building them. They've been doing it nonstop. I think they're soon going to surpass the U.S. in terms of the number of reactors they've got going. So yeah, they're faster at it than us. The Koreans are really good at it. I was in Korea this year. Yeah. Their nuclear industry, they've been going nonstop for 50-something years. Our industry pretty much ground to a halt around 1979 with 3 Mile Island. So we spent years doing nothing, and we never really recovered from that. We're working on it.
Well, we're going to keep Will Wade with us, Bloomberg News energy reporter. Someone else who's working on it, too, to build out nuclear capacity is James Walker. He's CEO of Nano Nuclear Energy. It's a $2.3 billion market cap nuclear energy company that is working on SMRs, small modular reactors. Shares are up nearly 90% so far this year. Big chunk, though, of the float is short. James joining us from Vancouver. James, come on in on this conversation. I mean, realistically, how long before you actually get an SMR built and it's up and running?
It's a good question because it gets asked, as you can imagine, more than any other question. And there's kind of two answers to it, too, because to get a reactor built and constructed and licensed is one question. But the other question is, how long is it going to take for the fuel supply chain to be built back adequately in the country to be able to mass manufacture the fuel to allow the mass manufacture of reactors? So on one side, our company is already going ahead with a construction project, 2 construction projects to build reactor systems. And we're talking to data centers and all of those sort of groups as well. But on the other side, like we even our company, we need to get involved in that fuel supply chain and build it back, because as Will was saying just before this, sort of after 3 Mile Island, the investment into the country sort of broke down a lot. We need that investment to go back into rebuilding that fuel supply chain so companies like ours can mass manufacture the reactor systems.
But James, on Carol's question about a timeline here, what would be a realistic timeline for completion of your first modular nuclear reactor?
So we're doing a drill program right now. It's already started on the site. So we'll have the geotechnical data to submit for a construction permit. That'll go in early next year. NRC will turn that around in 2026. So construction 2027, 2028, 2029, and then fully licensed reactor operating commercial license 2030 is very reasonable timeline. So I would say early 2030s, then you're going to see the mass rollout of reactor systems, so dozens on an annual basis.
Yeah, that timeline fits with what I hear from a lot of companies. Early 2030s for a significant wave of new power plants. But I guess the issue is that we have all these people who want power yesterday. How do we meet their needs?
Look, it's actually a very reasonable question. Like, as a company, we want to be conservative and truthful with everybody, because we got to earn long-term trust here. There are good interim solutions. Like I know companies have been exploring things like gas, and to be honest, if they can get hold of that in the interim, great. But even things like gas contracts, they're all tied up for 7-8 years. Turbines around gas are tied up for 7-8 years too. So there's no easy solution here. Even bringing in, as you mentioned, like wind and solar or anything like that, these are intermittent technologies which require huge battery storage technology to run alongside them. A lot of the time it's just not feasible. They're also very locationally dependent, so you'd be limited on where you can even deploy these things. I mean, unfortunately, there's no great solution, which is why when the show started, they were talking about opening up these old power stations and recommissioning old nuclear power plants, because those are some of them are the interim solutions. It won't be enough power, but it'll be some.
Yeah, those restart projects, that's the low-hanging fruit. Do you think there are other plants that we can restart, or is it just the ones we've already seen? Are we exhausted that list?
So it's a good question. Like, there's a number have been shut down. And like, it's arguable that you mentioned Indian Point as an example. I know it wasn't politically popular, and maybe there was some of that related to the decisions around that kind of plant. That could be a route. Even the old 3 Mile Island plant, since we're bringing that up, is I think it's either Microsoft or Constellation were involved in recommissioning that and trying to get that back up and running.
Yeah, Constellation says that'll be ready by 2027.
There we go. So, like, I think, as you say, like, there's going to be big projected power demand increases in the country. They might not get solved until we get to those 2030s. And the problem there is that could mean a stagnation in the tech industry. They'll find every means they can to get power. But like that big online co-location, green technology that provides baseload power, that can only really come from nuclear. And a lot of these reactor systems, despite any really outlandish claims about deploying near term, it's going to be early 2030s, 2030 and onwards.
All right. So the demand story is compelling, yet the obstacles are just as apparent. Those aren't my words. Those are Will Wade's words, who reports on this sector, as you well know. I mean, help me out here, though, because I'm just wondering, if I'm looking at a stock that is up 80% year to date, you guys don't have any revenues, right? I mean, like, are investors, this is what we do. Like, are they probably getting ahead of themselves? 30% of your float is short. So investors are just kind of waiting for something maybe negative to hit because they're negative, the sentiment. I mean, realistically, you're talking at least 5 years, right? Before you're showing significant revenue or earnings or anything along those lines.
No, revenues in our company will come online a long time before that. I mean, because there's this massive build back, the opportunity at the moment in the nuclear space is huge. It can come through the fuel supply chain or transportation or isotopes. Like, the nice part is that we're part of this build back effort. So, and look, the stock market is always about an investment in the future. I mean, the nice part is that the demand is there in a way that's unprecedented. Like, buying now really is an investment in the future, and a future that's inevitable. The tech industry is not going to just give up and pack up and go away.
But what if the AI spend and build out is, I know everybody comes out and says no bubble, or a lot of people do. What if there is, though, an overspend? Where does that catch you guys potentially?
I think the bubble has only been discussed around AI, but like in terms of data centers, those are things that cannot be bubbles. That is power that's needed for our whole tech industry. Like, a data center cannot be a bubble. Like, if you need increased power for computing power, it has to come from somewhere. AI, whether that's going to bear out the fruits of what's been promised, that remains to be seen. But currently, it's just expanding. But it's kind of irrelevant to the long-term power requirements, because the electrification of the country, the reindustrialization of the country, that's all going ahead. And you mentioned stocks like ours and the short interest. Great. If people want to short us, that's better, because we've gone higher and higher as a stock, just because every time the shorts have been squeezed. The more shorts, the better for us.
That's
because
fair.
James, only 10 seconds left, but would you say that you are most further along than any other company, the most along than any other company in the space?
In terms of microreactors?
Yes.
100%. I believe we'll have the first US constructed full-scale commercially licensed microreactor in the country.
Well, you can put an SMR in my backyard, because my monthly electrical bills are crazy. We're shutting off lights.
Carol, you're glowing today.
Yeah, I'm glowing. Will Wade of Bloomberg News and James Walker, CEO of Nano Nuclear Energy. Guys, thank you so much. Great discussion.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.